Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. These are the three things that you need to know today. First up, geopolitical risk front and center for investors this morning after Israel launched waves of airstrikes against Iran's nuclear program and ballistic missile sites overnight, in what is a major escalation that risks sparking a wider war in the Middle East. Stocks dropping and safe havens rising as investors shun risk assets as Israel's Prime Minister Benjamin Netanyahu says attacks will continue for as long as needed, with Iran vowing more in retaliation. And President Trump speaking out on the attacks, urging Iran to accept a nuclear deal to avoid further attacks. In other assets on the move, oil surging by the most in 3 years today amid fears of a wider war in the region that accounts for a third of global crude oil production. Market watchers predicted potential price spikes to $80 or even $120 per barrel. Energy stocks all trading higher with oil as Iran declares Israel's attacks a, quote, declaration of war. And an update in the Boeing Air India crash that killed more than 240 people. Air India plane crash investigators reportedly located the first black box from the Boeing Dreamliner wreckage on Friday. The data will be vital in determining what caused the passenger jet to crash minutes after takeoff, killing all but one of the 242 people on board. Boeing executives, including CEO Kelly Ortberg, also scrapped plans to travel to the Paris Air Show next week, where they'd been expected to showcase Boeing's progress and unveil orders. GE Aerospace, which made the engines on the Dreamliner, canceled a June 17th investor day in Paris. Israel began a major operation against Iran late Thursday, launching a series of strikes aimed at Iran's nuclear program and military leaders. Security camera footage captured explosions in Tehran overnight. Footage aired by Iran state media showed columns of smoke rising over Iran's main nuclear enrichment facility after the strike, but early reports suggest no elevated levels of radiation. Buildings in Iran's capital sustained damage during the strikes, and Israeli Prime Minister Benjamin Netanyahu said the military operation would last, quote, as many days as it takes, end quote. Iran retaliated early Friday with over 100 drones, the nation's military reported. Oil prices surged Friday as a result of the escalating attacks, and crude oil prices erased year-to-date losses driven by global tensions and OPEC Plus output. Bloomberg Economics projected oil prices could reach as high as $130 per barrel. U.S. defense stocks rose sharply higher in early Friday trading as well. Secretary of State Marco Rubio said Washington was not involved in Israel's attacks, urging Iran not to target U.S. personnel in the region. President Trump called on Iran to make a nuclear deal before there is nothing left in a post on Truth Social early on Friday, warning that Israel's next attacks could be even more brutal. Geopolitical risk rattling investors and global financial markets this morning. So, how should investors on edge prepare for increasing geopolitical tensions? Joining us now, we've got Alex Morris, FM Investments CEO and CIO. Alex, good to have you here with us today. Just help us make sense of what we're seeing in the region as it is, of course, being evaluated through the lens of investors here this morning.
Yeah, certainly some terrible things happening across the world, and investors should take note of that as we think about how do we position our portfolios, but just the overall theme of what's happening, right? Geopolitical tension is up. Things are getting less certain, not more certain. And as a result, it's not the time to be taking outside risk. This is a great time to be looking back to your asset allocation and to be really processing how do you want to be positioned for when things go wrong, which is something we often talk about, but we actually seldom actually implement. So this isn't the time to be taking out leverage into the long end of a Bitcoin trade. This is a great time to be going back to basics and sticking to the asset allocation and trying to see past the next 2 or 3 years.
Worth noting, Alex, that this comes just after the S&P 500 hit its highest close since February 20th, which was just one day after the benchmark index most recently set a new record closing level. We were reporting on that on Yahoo Finance yesterday into and after the close here. And now you have this move off of those levels. driven by, once again, more uncertainty internationally here. What is the risk that this actually spirals into something more large that investors also have to take into consideration?
Well, I think this is a reminder of what was always going on. I suspect if you ask the Israeli high command, they would tell you October 7th was a declaration of war, and they've been at war for a long time. This is merely a new front. But from an investor, we're looking at some other stats as well. We are going to hear from Jerome Powell later today. We don't expect to see any cuts, but I do think we are going to hear about softening some language, and cuts are probably the only thing that are more certain as a result of this. The question is now when. It's not today. Will it be just after Jackson Hole? Will it be nearer the end of the year? We look at CPI that's going up. So the cost to consumers is going up. The producers are going down, which means that corporate margins are somewhat being squeezed. So we're starting to see other little cracks. And this is what the deterioration of the economy looks like. It's happening in slow motion. And Jerome Powell's almost schoolyard logic of in January of let's just wait and see. Well, this is what the C looks like. So now we're going to get an interesting opportunity for the Fed to actually try to engineer that soft landing. And the technocratic job they have to do in making that happen certainly gets much harder when political forces say cut rates now, cut them by 2%. And then on top of that, geopolitics seems primed to spike oil, which is an impact to inflation, but also just add net uncertainty to a market that was just starting to find its feet again.
I wonder, has the profile of safe haven areas of the market changed dramatically? And the reason I ask that is because of where we're already seeing overcrowded trades within the market as of right now, both long positions and those who have kind of looked across the tech industry and the Mag 7 and said, hey, that might be the new safe haven if we're just sitting in a position long term anyway.
I think a lot of folks have made that trade for the last few years, certainly post-COVID. And it's probably a great place to be in that sense. If you define safe haven as something that I could also call a safe haven in 1950, then maybe not. But practically, if what you want is that 5-year over the horizon view of things, a tech stock, the Mag 7, they're probably not going anywhere. Certainly, you are going to see some volatility, in certainly a name like Boeing, the defense stocks that you showed earlier in the show. You're going to see some action there. So short-term profits to be made taking those types of risks. But long-term stability, we're still going to have our iPhones 5 years from now. And that's probably the one thing that we can count on.
Yeah, not if Sam Altman and Johnny Ive can say anything about it, but we will see what they put forward. See. Yeah, exactly. Alex, thanks so much for taking the time here with us today.
Thank you.
Certainly. Oil futures spiking, seeing their biggest gain in 3 years. And as we're monitoring the violence that's breaking out between Iran and Israel, this is prompting concerns around the outlook for supply in the region. Joining us now on the outlook for energy sector here, we've got Fernando Valle, who is the Hedgeye Risk Management Energy Analyst. Good to have you here, taking some time this morning. Just walk us through where this immediately kind of initiates some of your attention to flow into, especially when we do see conflict like this arise in the Middle East once again.
Absolutely. I think to us, the first place to look is the oil E&Ps. They probably have the most beta, and it was a sector that was beaten up already. We actually upgraded several names, including Diamondback, Matador, and Permian Resources to the long side. A couple weeks ago, we were starting to see already a trend moving in oil that made us more optimistic. And so we moved those names higher to the long side. Now, with obviously oil coming up 8%, it gives a lot of relief, especially to the ones that have higher leverage. None of those names are particularly high leverage names, but some of the other ones on the oil E&P side, they'll get some relief because at 63 WTI, they really weren't doing so well. They couldn't grow it. In fact, they should probably be declining slightly. And at 70, they get a little bit of a respite there. They can grow. They can potentially even lower their leverage over the next couple of weeks.
Occidental Petroleum, Exxon, Chevron, all U.S. energy plays, and they're all the top trending tickers right now on the Yahoo Finance platform here. How should investors be really analyzing the U.S. specific energy sector names?
Yeah, so with Exxon specifically, it's worth mentioning that they have a lot of production in Qatar gas. It's a very significant part of Exxon's earnings. which is obviously in the midst of the conflict. Qatar shares the North Field with Iran, and a lot of the exports go through the Strait of Hormuz. So there's some risk there. ConocoPhillips and Shell, Total all have participations in that field. When you look at Oxy or Chevron, they have less exposure to that area. Oxy is probably even the least out of all of them. I mentioned all the pure U.S. E&Ps. I think they get more of that leverage. And also because on the refining segment where Exxon, Chevron, BP, they're all exposed there, I think this is negative for the refining segment. And so with the pure oil E&Ps tend to do better in this overshoot of oil.
Fernando, I wonder, from what you've been able to analyze in prior instances, how long is the tail in terms of the impact that we're talking about after the initial strikes and event that sparks the volatility to the point where we eventually see some falling action, but perhaps there's still a little bit of overhang until there's real resolution that seems like it might be emerging?
It's typically not long. You've seen it with the attacks in Saudi Arabia a few years ago, and then with the October 7th. This lasts a little bit. I have a friend who always says oil always overshoots, and typically wars and attacks are a good time for you to sell because you get that opportunity to sell into strength. So we'll have to see here how long the attacks go on, but typically does not take long after these initial skirmishes before it reverses. I'll say you talked about oil. Some prognosis that we're going to $120 a barrel. As your previous guest was saying, the issue is that the consumer can't really afford that level of pricing, and so demand would come down significantly. So I would put a very short. I don't think that's a very likely occurrence that we'll get to those levels unless there's a significant shift in the economy.
Just lastly, while we have you here, OPEC Plus was anticipating that there would be a supply surge over the summer. How much can that potentially offset some of the initial move that we're seeing the markets react to right now?
Well, not much, because a lot of that surplus would have come from that region. Most of Saudi Arabia's production's on the East Coast. Kuwait, the UAE, they all export through the Strait of Hormuz. So if that is the area of concern, it doesn't really alleviate much. The other point is that they're moving the quotas, but the production itself will be below what the quota announced, the headline number, because they're really just allowing countries that have been overproducing to now match what's already there. So if they're saying about unwinding 1.3 million barrels a day, the likelihood is that we're going to get 700,000 to 800,000 barrels a day of actual production growth.
Fernando, great reminder, great context. Appreciate you joining us this morning.
My pleasure. Thanks for having me.
Air India plane crash investigators reportedly located the first black box from the Boeing Dreamliner wreckage on Friday. The data will be vital in determining what caused the passenger jet to crash minutes after takeoff, killing all but one of the 242 people on board. Thursday's tragedy was the first major incident for a Boeing 787-8 Dreamliner, but follows two fatal crashes of Boeing 737 MAX aircraft in 2018 and 2019 that led to more than 340 deaths. Boeing CEO Kelly Ortberg canceled a scheduled trip to the Paris Air Show to focus on this investigation. The air show is the global aviation industry's largest trade show of the year, where many aircraft orders are typically placed by airlines. Aircraft engine maker GE Aerospace, whose engines were in the Boeing 787 plane, also postponed its investor day. We'll continue following this story and bring you updates as we have them. Much more coming up on Morning Brief, including full coverage of the escalating situation in the Middle East as growing concerns prompt investors to sell risk assets. Plus, we'll hone in on the defense sector as those stocks surge amid the conflict. And we'll zero in on what this means for crypto as Bitcoin slumps amid the developments. Full coverage ahead on Morning Brief. Now time for some of today's trending tickers. We are watching RH, Adobe, Walmart, and Amazon. First up, RH soaring after the company said it's taking steps to offset higher costs from tariffs, moving production out of China and increasing manufacturing in the U.S. The luxury furniture retailer also sticking by its sales forecast, expecting full-year revenue to grow by 10 to 13%. This after the company topped expectations in the first quarter. Next up, we're tracking shares of Adobe, raising its full-year outlook after topping second quarter expectations. The software company reporting record quarterly revenue up 11% from a year earlier. Taking a look at shares, still slumping right now by about nearly 5%. And finally, Walmart and Amazon are exploring issuing their own stablecoins. This is according to a report from the Wall Street Journal. Stablecoins could allow the companies to bypass traditional payment systems, which cost them billions of dollars in fees each year. The retailers' final decisions will depend on the Genius Act. This bill is currently being debated in Congress, and the bill would establish a regulatory framework for stablecoins. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, Meta finalizing its deal with Scale AI, investing $14 billion and hiring the company's CEO, Alexander Wang. Meta will have a 49% stake in the artificial intelligence startup. Joining me now, we've got Gil Luria, who is the D.A. Davidson head of technology research. So, Gil, just take us into your assessment of what this means in effectiveness for Meta and their own ambitions with AI.
This is unbelievable. It tells you that Mark Zuckerberg thinks that having one of the most competitive AI models is the most important thing right now. Making a $14 billion investment, not to even buy a whole company, but just to have the head of a company head up your AI effort is remarkable, even for somebody as aggressive as he has been. And we're also hearing that they are making 8 and 9-figure offers to AI engineers. And what's even more remarkable is that some of those engineers at OpenAI and Anthropic are turning it down because the value of their stock in those entities is higher than that. So it tells you how important this is to Meta and how far behind they feel they are right now.
And so, as we're looking to how immediately accretive some of these efforts will ultimately be to Meta's business, what should investors be keeping tabs on how the company is talking about the roadmap and how these features will ultimately play out in some of where monthly and daily active users already engage?
So the investment in the core science, which is what this is about, will not bear fruit anytime soon. But what does happen with Meta is they are able to use better and better AI technology to sell more ads, to sell those ads for higher prices. And that's how they can justify their very high rates of investment. They're investing almost as much as Google, Amazon, and Microsoft in their data centers and in their AI effort, not just because of their importance on having a great AI model and being one of the best frontier AI models, but also because it makes their core business better. And that's how they're justifying it and why it's been improving their results for the last few quarters. They've been able to have high teen growth rates in their ad business, which means they're gaining share from Google, really, because they're selling more ads and they're selling them at a higher price.
While we have you, Gil, I want to switch gears, talk about a company that just reported earnings after the bell yesterday, and we're tracking shares of Adobe. They're still slumping just a little bit here. We're taking a look at some of the actuals versus the estimates, beat on top and bottom here. What do you think it is that investors are still hung up on right now?
So investors are ignoring the fact that Adobe has had great results yesterday and for several quarters. They've actually been one of the most resilient companies over the last few years in terms of handling very different types of environments. Investors are really just preoccupied with the impact of AI and Adobe. And we believe that have wrongly concluded that Adobe will not do well in the new era of AI. We believe it is quite the opposite, which makes Adobe probably the best value in all of software, maybe the biggest dislocation of software, because we see them benefiting from AI as they integrate these newest models and image generation and video generation to their product, not a victim of AI. But that's the controversy in the market right now, and that's what creates this opportunity.
And so how much more margin do you think they could really accelerate in terms of bringing shareholders even more value by showing that they're able to be a more profitable company and increasing the profile of their own profitability given the additive of AI that they're layering in to these services?
Yeah, that's exactly what they have to prove right now. And yesterday on the call, they talked about believing that they not only can continue to grow this business by 10% going forward for years, but also expand margins from an already best-in-class 45% operating margin level. So that means double-digit earnings growth for years to come. There's very few software companies at this scale that can say that, and they just confirmed that last night.
All right, you have a buy rating on the stock and a $500 price target. We'll continue to track how Adobe does. Lastly, while we have you, Gil, because you have quite the coverage universe here, I got to talk about and bring up Microsoft here this morning. And of course, slumping just a little bit. The broader markets are pulling back given some of the tensions in the Middle East. And of course, that naturally throws a wrench in some of the recent highs that we've bumped back up against. But for Microsoft here, what's core to the driver that is really going to have investors swooning over this stock for years to come?
Yeah, so Microsoft is offense and defense, right? In terms of their core business is the enterprise business. That business is going to be much more resilient than a consumer business that may be impacted by any shifts in the economy or disruptions to the economy. So that makes them the most stable of the mega caps. But then there's also offense. They have the fastest growing hyperscaler. Azure grew 35%. They're growing so fast, they have to offload demand into smaller hyperscalers. They are at the center of what's happening in AI. They have been for a couple of years. They had a little bit of a hitch towards the end of last year, the beginning of this year, but they've reemerged even more victorious. So that's why they're the best performing of the mega caps, and we believe they'll continue to be the best performer.
Gil, I only got about 30 seconds here, but as you're thinking about Microsoft and the mega cap stocks right now, even amid some of the geopolitical tension that we've been tracking and the breakout of even more conflict in the Middle East, does that make some of these Mag 7 stocks even more attractive? As even though it is an overcrowded trade right now, it seems like that is one of the new defensive plays, if you will.
Yeah, Microsoft, Amazon, to a certain extent, Meta, these are companies that are in very good shape, have been performing well, are more resilient, more diversified across several businesses, and have a more limited impact from the consumer than maybe some other stocks or cyclical stocks in the economy. So we do believe that they will be a somewhat of a shelter to the extent that there's even more disruption.
Gil, good to speak with you as always. Thanks so much for taking the time here early, I know, this morning as you're on the West Coast. Appreciate it.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. Just seconds away from the opening bell on Wall Street and in Midtown Manhattan at the NASDAQ. There you're taking a look at today's esteemed bell ringers. At the NASDAQ, you've got Millicom Tigo ringing the opening bell. And at the New York Stock Exchange, it looks like you have Catholic Charities ringing the opening bell. Great bell ringers on both sides. Got some funfetti there in Times Square. All right, let's take a look at the major averages as we begin today's trading session, riddled with conflict right now in the Middle East as investors waking up this morning, firing up their trading engines. And as we're taking a look at some of the major averages, we're seeing where some of that slippage that was already being shown in the futures now transpiring into the opening cross here. The S&P 500 right now down by about 0.8%. Dow Jones Industrial Average, that's lower by about 1.1% to begin today's trading activity. I also want to pull this up on a chart view just so you can see how the S&P 500, we had actually gotten back to one of our highest levels since February here, highest close since February. And so taking a look at the year-to-date move here, we are still holding on to gains year-to-date for the S&P 500 of about 2%. But this is exactly where we wanted to show traders where we had been kind of leveling off here, and this was a key level for us to continue to track. Tried to draw you a straight line here. I needed to get my yardstick out in order to make sure that we could fully get that carried out. But ultimately here, with the absence of a yardstick, there you can see visually with your eyes just those levels and where we're coming in at. The Dow Jones Industrial Average still flat, just barely to the downside as of right now, year to date. And then the NASDAQ Composite, which is calibrated here on our Wi-Fi interactive data. We've got that lower by about 0.9% to start off today's trading activity. Year to date, up 0.9%. Want to take a look at some of the heat maps that we've got fired up for you here. The only, and this should come as no surprise, the only sector in the 11 S&P 500 sectors right now in positive territory, that is energy. As oil prices move higher, XLE, you're going to see that go with it as well. That's up 2%. 10 of 11 S&P 500 sectors in negative territory right now, dragged on the most by consumer discretionary names. That's down by about 1.2%. Additionally, want to take a look at the NASDAQ 100 here, give you a quick look at some of those Mag 7s, as well as the mega cap tech stocks. And as of right now, you can see only a few areas of green peppered into this mix here. As of right now, the one outsized leader that we're tracking is actually Diamondback Energy. And of course, this synonymous with what we were just talking about with the sector activity and the bid that energy names are catching here this morning in reaction to the oil price spikes here. Taking a look at Diamondback Energy, that's leading the pack. It's up by about 5.4%. However, pulling up the caboose right now, you've got Adobe. That's down 4.25%. Fresh off of earnings here. However, you still heard some of the bullish sentiment from our previous guest, Gil Luria of D.A. Davidson here, and how he's evaluating that name. A few other names that we're tracking here out of the gate this morning. You've already got Marriott down right about 2.7% right now, and then a host of other names in the red, majority in the red here on the NASDAQ 100 as of right now. With that, let's get into today's strategy session. Geopolitical risk hitting stocks today as investors de-risk into the weekend and brace for escalating tensions in the coming days. All of this halting gains that were close to taking the S&P 500 back towards records. Joining us now, we've got Michael Reinking, who is the New York Stock Exchange Senior Market Strategist here. Michael, just give us first the pulse that you were sensing from some of your colleagues on the floor of the exchange this morning before you made your way here to our studio, and what you're hearing from them right now.
Yeah, so thanks for having me back in studio this morning, Brad. Look, so I think we're seeing the typical kind of conflict playbook. This morning you're seeing equity markets move lower, oil prices, gold higher. But there are some interesting wrinkles kind of within that. You're seeing the dollar rally, but we're not even kind of getting back to the losses that we had seen kind of as of yesterday. Treasury yields are moving a little bit higher. Typically, you'll see Treasury yields move lower in kind of that risk-off environment. But you have that push and pull of how this is going to potentially impact inflation on a go-forward basis, right? So, the move in general, though, is pretty muted. If you look at the S&P 500, right, we're essentially unchanged for the week, right? So we haven't really kind of seen a significant drawdown. Markets are going to be in kind of a wait and see in terms of kind of what the response is, how that whether how aggressive that response is, and whether you start to see kind of oil markets impacted elsewhere within the region.
It's so interesting because this is a market that has really overweighted any semblance of good news that's come forward here. And one of the areas, even amidst this bad news that's transpiring right now, is what we could potentially see in any type of materials or rare earths deal. And one of the tweets social media posts that had come out this morning was from Donald Trump, President Trump, saying that he had given Iran a 60-day ultimatum to make a deal. They should have done it. Today is day 61. Told them what to do, but they just couldn't get there. Now they have, perhaps a second chance. All that considered, what is the likelihood that we see any type of deal unearthed at this juncture, and what would the markets even do with that information?
Yeah, I mean, so in terms of Iran, I think one of the surprising things was the timing of the strike last night, right? Yeah. So we were supposed to have negotiations on Sunday, right? Those are likely off of the table right at this point. So I think there was a little bit of a surprise just in terms of how quickly the strike had. But markets started to sniff this out a little bit, right? Coming into today, right, oil markets were up over 5%, right? We had the Atomic Agency say, just this week, also saying that Iran wasn't in compliance, right? So, I think markets have, somewhat, kind of sniffed this out a little bit, but, we're not necessarily kind of seeing kind of that big risk-off move at this point.
What are the hallmarks of that safe haven playbook that you were talking about, investors really thinking through and activating here this morning on the back of this?
Yeah, so I mean, we're in terms of kind of the safe haven move, right? We're kind of you're seeing kind of strength. It's not really a safe haven, but the obvious move into energy stocks, right? You're seeing travel-related names, kind of under pressure. And then you're seeing kind of some strength, kind of within that U.S. dollar, the U.S. dollar. I know you've spoken a couple times this morning, with some of your guests about the idea of the Mag 7 being kind of a defensive sector. We've seen that kind of over the last couple of years that investors have moved that way. And if you think about it from a perspective of this isn't going to derail kind of the AI demand that's out there, right? So it's sort of insulated from any from this sort of geopolitical risk, right? And we also had kind of very, very solid numbers from Oracle this week, pointing to just the insatiable kind of demand and kind of that they continue to see across that space.
I want to hit on two more themes while we have you here, or two more major topics that the market is really weighing through. One of them being what you and I were talking about in the break when you came on set, which is, we made it through this auction week for some of the 5, the 10, and then the 30-year bonds, and the 20-year, that might be a nothing burger when that comes about. We will see, but overall, we kind of were able to make it past that and still see a sense of demand, not just here, but also internationally here. I was looking at this chart from Apollo chief economist Torsten Slok, where he said that foreigners have reached record high exposure to duration in U.S. Treasury markets. What's the significance of that demand and the interest that we're seeing right now?
Yeah, and so I mean that was one of the concerns that we had over the last couple of weeks, right? We had seen kind of the weak auctions, kind of out of Japan, kind of trigger some more concern into our last 20-year auction. That's as we sort of mentioned off air, that's kind of an orphaned kind of product. So we had that little bit of volatility right after our last 20-year auction. But this week was very important in terms of seeing kind of very strong 10-year, the very strong 10-year auction, and yesterday's 30-year auction. Next week we have some really big catalysts, right? As we move into kind of the central banks, we have the BOJ on Monday night. I think while they're expected to leave rates unchanged, investors are going to be paying close attention in terms of kind of if they try to use any rhetoric to kind of talk about kind of containing the recent move higher in longer dated yields, kind of there. And then obviously we have the Federal Reserve, who's kind of got a new bit of risk to kind of contend with after today's action.
I only get 15 seconds. One of our guests earlier had said we're in this wait and see from the Fed. That's what we continue to hear. And this event that's transpired overnight is the C. So what do you think is going to happen once we get to that mid-June meeting?
Yeah. So look, I think this adds a little bit of uncertainty. They're still in a wait and see. It's going to add some uncertainty for the Federal Reserve, right? They're not going to change their stance, right? I think the inflation data that we had seen this week was somewhat encouraging. There is some skepticism, right, looking at that data because we're not seeing the impact of tariffs, at this point. But what that does kind of help the Fed do is point to the idea that you've seen, kind of the disinflationary process, kind of in place, kind of ahead of tariffs. Right. They may start to kind of set the table to, for a fall, rate cut. And by setting, I'm talking about kind of putting the tablecloth down. Sure. Right. July might be kind of the silverware and plates. Interesting. Right. And so I think you could start to see a little bit of softening of tone. But now you have this oil shock, which potentially will feed through to the inflation numbers as well that they're going to have to contend with.
Michael, great to see you as always. Thanks so much for taking the time.
Thanks for having me.
Certainly. Let's get to 3 market movers you need to watch for the trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Thank you, Brad. We are watching some of the indices give back all of their gains for the week, so some of them turning negative. We will go over that, along with some of the weekly winners and losers. And we got to talk about commodities getting rocked thanks to those strikes on Iran and also WTI. We're going to mention that as well. So let's go back to the indices. I'm going to show us a 5-day view of the Dow. Here we go. You can see it's in negative territory, down only about 2/3%, but that would end the 2-week streak, not extend it to 3, that we have going going here. Here's the NASDAQ also in slightly negative territory, and the S&P 500 just in barely positive territory. And finally, the Russell 2000. I've been saying the small caps have been leading this week and partly last week, but they are at least retaining about 1/3% of those gains right there. We got to move on to some of the weekly winners and losers, and for that I'm going to go to our heat maps. This is what's happening today. Not surprisingly, with crude oil jumping 7-8%, energy is in the #1 slot. It's also in the #1 slot this week. It was already there. We'd seen some movement earlier. Healthcare is #2, and then tech is #3. And I got to call out XLK here because that has just reached a new high only yesterday, just barely, but that did qualify as a record high, the first since February. And that was where the general market topped. To the downside, we have financials, industrials, and communication services. Leading to the downside, industrials notable because it is the best performing sector on the on the year. And let's go to some of our leaders here because this was interesting. For the top spot, PSCE is a small oil ETF. That's up 7.6%, trouncing everything else. And in the second place, we have the SOX chip index. Then we have gambling, home builders. We also have biotech, Korea, Magnificent Seven, ARK is in there. So a really interesting mix of leadership to the upside. To the downside, what has not been working? #1 here is regional banks, but we also have XRT, that's retail. And then ITA. I got to call this out because we were just talking about, I've been talking about the incredible streak it's having, only a handful of down days since that April 8th low, but it has put in 2 or 3 down days since then, so that streak coming to an end as all things that are good must. All right, we got to move on to futures here. I will close with that. In the #1 spot for the week and also the day is going to be crude oil. It is up 7.5%, and I'm going to put on a 6-year chart, and you're going to see this is a big pop here. It's breaking to the upside in a big way. I was saying just a few days ago, a lot of people saying $65 open $75. We didn't think that was going to happen in 1 to 2 days, but nevertheless, and here's a 5-day view, really big pop there, got all the way up into the upper 70s. And then also in commodities land, look at the #1 laggard here. That is platinum futures, and I've been talking about how much that has been moving to the upside. And this right here, that high that we saw overnight or yesterday, that was a 4-year high, but now it has given back just about all the gains over the last 5 days. I'll leave you with a year-to-date on this, and you can still see it is up 34% there. And I got to close with the US dollar index because I was saying only yesterday it was probing 3-year lows, but it is bouncing today. You could call that haven flows. A lot of times when there's geopolitical turmoil, you will see that bounce in the dollar. I think that's all we're getting today. But be careful for all you dollar shorts. That is a consensus opinion. Lots of positioning that's short, and also sentiment is very bearish. That just means that the short squeeze to the upside could be all that much greater. And now we have geopolitics adding to those catalysts. So watch out for the dollar bears. Brad, I'll send it back to you.
Jared, thanks so much for setting up today's trading activity. Appreciate it. Coming up, defense stocks trading higher this morning amid escalating conflict in the Middle East. We're breaking it down next. Defense stocks rising this morning following Israeli attacks on Iran. Contractors like Lockheed Martin and Raytheon trading higher on expectations that the increased tensions and possibility of a larger scale conflict will result in additional military spending. Lockheed Martin led U.S. defense funding in 2024 with $65 billion in contracts over the course of the year. RTX, Raytheon, General Dynamics, and Northrop Grumman and Boeing, they rounded out the top 5 with between $30 and $40 billion each in total contracts. While Secretary of State Marco Rubio confirmed that the U.S. was not involved in the initial Israeli attack, the U.S. does provide defense funding to Israel with a record $18 billion in military aid in the first calendar year of the war in Gaza. The U.S. also approved $20 billion in arms sales in Israel in a deal this past August. Raytheon specifically partners with Israeli companies to maintain its Iron Dome and David's Sling missile defense systems. In May, President Trump called for $25 billion from the current budget to begin building a similar system in the U.S. called the Golden Dome. Estimates of the total cost of the system are $175 billion. President Donald Trump on Saturday set to host a massive military parade in Washington, celebrating the Army's 250th birthday and anniversary. The celebration is expected to cost as much as $45 million. The event will include hundreds of military vehicles and thousands of soldiers. The celebration also coincides with the president's 79th birthday. More than 50 helicopters and aircrafts will fly over the city during the event. The Federal Aviation Administration said it will issue temporary flight restrictions for the Washington area on Saturday. In an AP poll conducted in early June, 6 in 10 adults said that the parade is not a good use of government funds, but more people approved than disapproved of the decision to hold the parade. Coming up, crypto falling as investors pile into safe havens. Is the risk-on rally over, for right now at least? We're breaking it down next. Bitcoin still holding above the $100,000 level, but losing some ground as stocks slump amid increasing Mideast tension. We're taking a look at crypto-related stocks as well, including Coinbase, also largely lower along with the broader market. So does this spell the end of the risk-on rally for right now, or could impending legislation and a crypto-friendly administration prove to be a boost? I want to bring in Brady Dale, Axios crypto reporter here. Brady, good to have you back on the program with us. Just take us into your evaluation of what the mindset around riskier portions of the investment thesis, riskier assets like crypto, especially within the broader playing out of the Middle East tensions right now, how that is typical and what we should expect this time around.
Yeah, I mean, I think probably what investors are looking at is, does this war get a lot worse? And so I think that's why some people backed out. Now, keep in mind, the amount that Bitcoin is down right now is roughly 2%. In the crypto markets, that could have just been like a very lackluster Tuesday. I mean, the markets can easily move that much on nothing at all. So really, this is kind of a smaller shift down than I would have expected for something that could end up being so much bigger than it has become so far.
Yeah, certainly. It's also been a big week, we know, for cryptocurrency. You've got everyone from the president even opining in and weighing in. I saw our own Brian Sozzi, executive editor, post a video where even at the most recent conference that was taking place here in New York, there is still within the conversation this willingness or want and desire to make sure that the administration is positioning itself as continuously crypto friendly. How's that playing out?
I mean, this was a gigantic week in crypto legislation. More in the Congress side, the Genius bill, which is about stablecoins, got a cloture vote for a second time in the Senate, teeing it up for a very likely final passage vote sometime. I think we're looking at Tuesday right now. And so that's been a big fight in the Senate. And then over in the House, two different committees, the Ag Committee and the House Financial Services Committee, voted the Clarity Act to the floor. And that's an act that would just sort of decide how disclosures and regulations would work for cryptocurrency. And then on top of that, the final big regulator got a hearing in the Senate, Brian Quinten's the CFTC. So it was a gigantic week in crypto legislation.
If the stablecoin legislation is able to move forward, what does that mean for, of course, the poster child of crypto in Bitcoin?
Yeah, that is the big interesting question. Historically, thus far, when there has been more activity of really any kind in the cryptocurrency market, like, your viewers might remember the ICO craze of 2017, which was really all about Ethereum. That drove a ton of value to Bitcoin regardless. So that's what we'd expect. But, it could be that these things are starting to decouple. Stable coins are a financial utility. People can use them for a lot of reasons that have nothing to do with Bitcoin. So it could be that stable coins explode and we see a modest bump to Bitcoin, but no direct gigantic gain. Or it could be that the explosion of stable coins brings a lot more energy to Bitcoin. We just don't know right now. I mean, we're entering into a very new world. Yeah,
I imagine some of the prominent profiles that were promoting ICOs and then got dinged by the SEC certainly remember that period very well. Brady, thanks so much for taking the time.
Thank you.
That does it for Morning Brief. Joining me in the next hour, more on Catalyst.